Hey guys, it's Jag. REITs have become one of the only investments that have managed to outperform the wider stock market in a long period of time. According to data which compares different types of investments across a 48-year period, REITs have actually got a compound return of 11.8%, whereas the S&P 500 index fund has only got a return of 10.6% in the same period. If you're not sure what a REIT is exactly, it stands for Real Estate Investment Trust. It's a type of company on the stock market, a special type of company that holds and invest in real estate properties on your behalf. In return of you holding a REIT, you can get a dividend between on average 2 to 5% that is derived from rental income the REIT is able to generate. Now, none of what I'm about to say should be taken as financial advice, but the REITs I'll be discussing in this video later on should be a great addition to your portfolio for a number of reasons. Not only do these REITs have a higher amount of dividends compared to normal dividend stocks on average, these REITs have intrinsic value on the back end. They hold property, unlike some of the crazy valuations you see nowadays with tech companies, which high valuations and very little earnings to back it up. Although in a previous video I've touched based on UK REITs specifically, the UK is not the only company that has seen record level valuations in terms of property prices. Forbes published an article recently which stated that there is a 28% decrease year on year in the supply of properties in the US market. Fewer people wanted to sell off their properties and more properties in demand. It shows that the US property market is headed in one direction, and that is accompanying Elon Musk to the moon. The first REIT we're going to be looking at is the Realty Income REIT. Unlike other companies which give a dividend every quarter, this particular REIT gives a dividend every month and is currently yielding at 4.4%. It mainly specializes in commercial property across the US, Puerto Rico, and some in the UK. It currently has 6,600 properties, with their tenants being large US brands such as Walgreens, 7-Eleven, and even Sainsbury's in the UK. One thing I love about this REIT is that it has strong historical performance. It's given a 15% total annual average return since it launched in 1994. Now it also brands itself as the monthly dividend company. Now to me this shows that they put a lot of value to their investors, rightly so, because they've also actually are part of the S&P 500 Dividend Aristocrats Index. It's quite tough to be a member of this index. You have to have 25 years of consistently increasing your dividend year over year, and only a very small, minute amount of stocks compared to the wider market have actually managed to do this. If one year the Realty Income REIT decides to cut its dividends, they'll be kicked out of the S&P 500 Aristocrats Index. In effect, they will lose so much credibility, so it's unlikely, to me at least, that they're going to cut their dividends if they can afford it. The mere fact that the company has been increasing its dividend for at least 25 years shows that it's reliable as a dividend stock alone. Guys, you can buy this REIT and other REITs that I'll be mentioning on the free trade app. Now, if you use my link in the description, you'll be getting a free share valued between £3 to £200 when you deposit just £3 to the platform. This is probably the most easiest money you'll make investing, because you don't even have to invest that £3, you just have to deposit it to get your free share. Now before we move on to the next REIT, which allows you to collect rent from Amazon, please do drop me a like and subscribe if you're finding this video useful in any way. Anyway, let's get back to it. The next REIT is Prologist Inc. This REIT is fairly diverse, with properties across Europe, America, and Asia. It mainly focuses on industrial warehouse type properties, in which Amazon is one of its tenants. I think the general warehouse sector has seen a massive boom due to online shopping. Companies need storage units to store products and to fulfill orders, and Prologist does this exact thing. I think by investing in this type of REIT is one way of betting that the online e-commerce market will continue to boom. Tenants of this REIT include Amazon, DHL, FedEx, and many more. In fact, they have quite a diverse tenant base with 5,000 plus tenants. Amazon only makes up 3.5% of their revenue. This is a really good thing in terms of diversification. If one brand unexpectedly goes bust, Prologist can just take it on the chin without impacting its bottom line that much. It currently gives a dividend of 2.20%, and it has increased over 140% across the last 5 years alone. Now yes, industrial REITs are the obvious choice when trying to take advantage of the growing digital economy. However, another beneficiary of this is data center REITs. The next REIT we're going to be discussing is the Digital Realties Trust. This REIT has over 275 data centers under its belt across 24 countries. You have the likes of Adobe using its data centers, where it's currently giving a dividend of 3%. Now, if you don't want to invest in individual REITs, Then the next best thing is investing in REIT ETFs. One of the best property ETFs that are available in the UK is the iShares Developed Markets Property ETF. This REIT tracks the performance of the best REITs in the developed markets, minus Greece, and they have to have a certain amount of dividends to be included. By investing in this ETF, you're going to get some exposure into the REITs even mentioned in this video. In fact, Digital Realty and Prologist actually make up the top 2 holding in the portfolio. And the good thing about this ETF is that the largest weighing is only 5%. That shows that it's fairly diversified, with you not over investing in one particular REIT. This REIT gives a dividend of around 3.27%, giving you access to a large group of global REITs. Another ETF is the iShares US Property ETF. This specific REIT gives you access to the best REITs in the US that at least have a 2% dividend yield. In fact, the current dividend yield for the entire ETF is 3.30%, with an expense ratio of just 0.4%. In terms of its holdings, it actually is quite similar to the previous developed markets ETF. However, Prologist actually makes up 9% of the fund's weighing, so you have to factor that in. Although there is a case for diversifying your REIT portfolio so you have more of a global exposure, there is no doubt from just a tax and cost perspective that UK REITs are better for UK investors. The first and the most obvious reason is that if you buy UK REITs using pounds, there is no FX impact to your portfolio. I've seen in the past that even if I'm making a paper profit because of the appreciation, the FX impact is so large that it drags the entire investment down. But to be honest, the FX impact is just a side issue compared to the dividend withholding tax that is incurred by UK investors who are investing in the US. Normally, the US tax structure is such that any dividend that goes outside the US to a foreign national, so the UK investors, is taxed at 30%. However, you can get this cut down to just 15% when you fill in the W-BEN form. It's normally done for you anyway when you sign up to an investment platform like Free Trade. Now, whatever the amount is, it will definitely eat away at your dividend that is received every quarter. And it could honestly mean that you're better off investing in UK REITs if you're just after the income. I personally see a lot of potential in the REITs that I've mentioned, and I think that it's still worthwhile despite the taxes and the cost. The main benefit for a REIT investor is diversification. In case there's a downturn in the UK market, you have the US REITs that may be unaffected. If you haven't yet checked out my best UK REITs, then make sure you check out my video here. Otherwise, thank you so much for watching. Make sure you like and subscribe if you enjoyed this video and you found it informative. I'll see you in the next video. Thank you so much.